All right, everyone, welcome back to another weekly Roundup edition of On the Margin. Today, I'm joined by my contagious co-host, Mr. Mark Yusko. How'd you like that alliteration, Mark?
That is the perfect adjective. I love it, Michael. I am fired up today. And, I wrote something 4 years ago called The Virus is Spreading, long before COVID, and took a lot of blowback. People like, viruses are bad. Why are you saying that? I'm like, no, something, when it goes viral, when your enthusiasm is infectious and contagious, that's actually a good thing. So I do the reveal. I am wearing the bull market socks. The Bitcoin bull is back, baby. And I'm not going to call it absolutely, but if we surpass 21.9 on this kind of third rally, we've made 3 successive higher lows off the 17.5 wick, and I'm starting to feel like spring is coming. So I was early, euphemism for wrong, on winter, but maybe I'll be early and rightish on spring.
I've been listening to you pretty consistently. I will say, I think you've been more right than almost anyone else that I've been listening to, just in terms of timing here. Walk me through, for those of us who aren't familiar with the dark arts of TA, why is that pattern? Why does that tell you that we might have reached a bottom?
Yeah. So when you have, on the positive side, when you have higher lows and higher highs, and because markets chop, right? Markets don't go straight up. They don't go straight down. They chop because human beings react greed and fear. And there are 2 types of markets. Winter and summer are distribution markets, when people are selling, distributing, and accumulation markets, when people are buying. And signs of accumulation are when you get a low and then it starts to go up, and then people get afraid and they start selling and it pushes back down. But then there's more buying pressure, so it doesn't go as low. So you make a higher low, and then you go up again, and then you start to come down, and then you make another higher low. That pattern of higher lows is the formation of, you've heard it called a bottom, a rounding bottom. And if again, people say, drawing lines on charts doesn't do anything. No, it doesn't predict things. It doesn't cause things, but it lets us see patterns of behavior. And that's why, a month ago or 5 weeks ago, I tweeted out that thing about, look, the longer we stay on this flat, what's called a descending wedge pattern, where you're bouncing up and you're bouncing lower each time, the longer we stayed in that pattern around 30,000, the more risk there was of that cathartic puke. And I said 15, and we made to 17.5. So again, it's not about prediction precisely. It's about directionality and pattern recognition, and it's just because human beings are predictable. We do things in a predictable way.
Let me make 2 observations here. And maybe this is just kind of me looking at a chart, but one thing that has kind of surprised me a little bit is just how resilient actually Bitcoin has been in the face of pretty horrendous CPI print that we got yesterday. It kind of wicked down, right? But I think that was just the result of, and it's basically recovered everything since that, since that big move. On the other hand, I think the one thing that I've personally still been waiting for is just minor capitulation in general. You're starting to see that. I think Core Scientific announced that they were going to sell 7,500 Bitcoin or something like that. So I've got these kind of 2. I would agree with you that it's not financial advice. I have no expertise here, but it does kind of seem like we are certainly closer to the bottom than the top or whatever. But I'm still waiting. It still seems like how do you kind of measure that? Is there one foot to drop still from the miners, or do you view it as very bullish that actually Bitcoin didn't really move in the face of the inflation print?
I think that is bullish, Michael, and it's a good point. And the key thing, I sent a series of tweets yesterday about this on the traditional market and then relative to the Bitcoin market. The traditional market, not done. It's got a long way to go. And the problem is too much leverage, right? There's still a mass amount of leverage. We corrected the amount of leverage that was higher than 18, which is orders of magnitude higher than 2008. There's so much margin debt in stocks that needs to correct. And as it corrects, The problem for stocks is stocks are still 54% overvalued relative to fair value.
Mm.
They've only been this expensive 7% of the time. In all of history, 140 years of history, only 7% of the time have US equities been more expensive than right now. That includes the drop this year. On the flip side, Bitcoin has only been cheaper than its long-term history on 2% of the time, 2.5% of the time. Oh, you have my charts.
I do.
Look at that.
I do indeed.
That's kind of fun. They're not my charts. They are advisor perspectives charts. Doug Short started it, and Jillian, I can't remember her last name, keeps it going, and they're fantastic. And I love this one.
Yeah.
Right. The red line, stocks go up over the long term. Stocks go up. Why? Inflation. Right. Our currency gets less good, so the value of assets goes up. Earnings. Right. Companies actually earn money. And growth, right? There is economic growth. So those three things make that red line go up about 6% compounded in real terms a year. And the problem is stock prices reflect greed and fear. And the greed is when we're above the red line, and the fear is when we're below the red line. And you can be above or below for a long time, but we've been above for a very long time. And to get back to fair value requires 54% drop from here. It's crazy.
Yeah. For those of you who are just listening to us on the audio here, what we've got is we're looking at the real S&P composite from 1871 till the present day. And we've got the price to earnings ratio mapped out below, and we've got a trend line superimposed over both those things. So, on the S&P going back to 1870, which is just amazing. As a history nerd and a data nerd, this is pretty awesome. We're 118% above the regression line. And on the price to earnings side of things, so that's on the S&P. On the price to earnings, we're 38% above the regression line. And as you said, I think in your tweet, right, price to earnings, it's only been this expensive like 7% of the time in history. So I'm with you on that. I think it feels like there's still a leg to go lower in stocks. And again, this is
the one. I love it. And the thing about this is not PE like today.
Yeah.
This is called PE 10. This is 10 years of average earnings, which smooths the peaks and the troughs. And people are saying, the PE should be higher because companies make more in a low interest rate environment. Yeah, that's a specious argument because low interest rates are a sign of economic weakness, not strength. And so your future earnings growth is probably lower. But if you take a 10-year cycle, you get highs, you get lows, you get high interest rates, you get low interest rates. And so this is a really good indicator. And yeah, we're not in Stupidville in valuations anymore, but we're still in Silly Town. So
these are scientific terms, people. Stupidville versus Silly Town. I've got a question for you. I feel like I've been repeating this ad nauseum on like all the interviews that I've done recently. But did you happen to catch the interview John Collison did with Stan Druckenmiller?
I've seen snippets. I have not sat down and watched the whole thing.
It's worth a listen. It's pretty good. He had one anecdote that you will have lived through, so you'd probably resonate with. But he's describing his time period trading around right before the burst of the .com bubble, and he famously got kind of whipped around during that year, right? He went in. He made a little bit of money, then he went in big, lost the money, etc. So he was kind of describing this period of time that he took off after losing an enormous amount, basically trading during the .com era. And he comes back and he looks at the market, and there are three conditions that are in place. Well, I guess four. So the NASDAQ is still elevated, but at the same time that the NASDAQ was elevated, you had rising energy prices, you had a strong and rising dollar, and you had rising yields. And I forget who he said he spoke to, but he spoke to one of his friends and said, "Well, why are stocks still up when these three conditions are in place? This guy ran a regression. When those three things are true, historically, earnings would then crater 35% in the coming year.
Yep.
And he went short and made a boatload of money and ended the year up, despite having lost like over $1 billion before. Point being, those three conditions describe pretty accurately what's going on today, right?
What's going on right now. Look, this is 2001 redo. Mm-hmm. And, I've talked about this and talked about it ad nauseum. People forget 2000 was not the bad year, right? 2000 was the warm up. 2000 is when people went, oh, wait a minute, this is stupid. And we started to go down. But then we had this relief rally where the Fed said, we're going to save everyone and we're going to print more money. Because the Fed had printed one half of a trillion, not 10 trillion, but one half of a trillion leading up to Y2K because they were afraid the world was going to end. And when the world didn't end, people looked at stock prices and went, oh, geez, these are pretty high. And so March 24th, that was the top. But then the Fed came back in that first quarter of 2001 and said, no, we're going to provide liquidity and we're going to save us. And so we only ended up down 6% for 2000. But 2001, when Stan was getting whipsawed, was you had this rally. And we went all the way back almost to equal from, I think at one point down 14, 15%. So it was a vicious rally from kind of the middle of November through December into January, February. And then the stuff happened. All the stuff that Stan describes led to earnings revisions. So famously, and this is also happening right now. So you have these companies like Cisco that couldn't sell their inventory. So they wrote it off. And literally, then they started selling it again later at zero cost, which is just so insane. But they wrote it off and they said, oh, we have to restate all of our earnings from the last 5 years because we kind of exaggerated. And it led to the discovery of fraud. And there was a lot of fraud. There was Enron and WorldCom and all this stuff. And look, 2001 was a crappy year. It was down 14. But 2002 was the really crappy year, right? That was down 22. And so you still had plenty of time. And if you look at a bubble chart, at a traditional bubble chart, and you can maybe attach it to the show notes, it goes and has that false bear trap where it kind of falls. And then it kind of goes parabolic to the top, and then it rolls over. And then you have the last cathartic kind of turn up, and it's called a return to normal. As everybody's like, no, it really is a new paradigm, that term new paradigm, which anytime someone says that, just run away. And then you have the drop, and the drop accelerates through capitulation and fear, and then you get to loathing on the other side. And if you remember first quarter 2003, right before we invaded Iraq for the second time, that was when people were like, I'm done with stocks. I'm done. I never want to see a stock again. Institutions were like, we're not going to invest. And that was clearly a good time to buy them. That and war. War. We have war too. I mean, everything's the same.
It does seem like it's starting to rhyme. There's a great interview that complemented what you just said with Greg Jensen of Bridgewater that he just gave with Grant Williams that I would recommend folks listen to. Maybe we can link it in the show notes, but definitely worth it. He was pretty prescient. I listened to an interview he did about a year ago, and a lot of what he said has kind of come to pass, I would say. I mean, one thing that's interesting to check out during these conditions in general is, that's probably a good gauge, right, of just sentiment in general and whether people are going to be happy or not is just real average hourly earnings, right? So what we've got here is real average hourly earnings year over year, and you can see that they're shrinking. Now, I think if you would actually parse this out into different...
Michael, they're more than shrinking. They're collapsing. Mm-hmm. This is of historic proportions. Yeah. And it goes to the policy error, okay, on the left-hand side of, or the right-hand side, but not at the far end of this chart where, we revert around that mean, up and down, basically flat, because real wages have been flat since the 70s.
Yeah.
Right? I mean, it's crazy. And it's because, right, the Fed has been stealing the wealth of the masses and pushing it up to the elite, for decades. And real wages have been stagnant. The top 10% are up like 100 and something percent. I mean, it's crazy. And so they do it through this insidious thing called inflation. And if you go back to the other chart for one sec, if you look at that big spike up Okay, this is where people were saying, "Oh, U.S. savings rate is at all-time records." I'm like, "What are you talking about? You sent people a check for $1,200. That's not savings. That's not real. That is a policy error of epic proportions. It's led to all the things we're seeing with the currencies. It's led to, and I was at a conference the other day. Why I kind of look a little tired is I took the red eye home again, which I always say I'm not going to do, and I did again. But I was out in Seattle, and I did this conference, and we were talking about. I'm so tired, I forgot my train of thought. We're talking about what happened with the Bitcoin. I was making the case that Bitcoin is a good asset, and these people, we are so early, Michael. These people, like one woman came up to me and said, "I disagree with everything you said. This is a Ponzi." I'm like, well, look, if you don't know the difference between a Ponzi and a pyramid scheme, then we can't even have a conversation, because by definition, it is not a Ponzi. Not a Ponzi. You can call it a pyramid if you want, just like any other currency in the world, which is built on faith and belief and foundation. But you can't call it a Ponzi. But this audience wanted nothing to do with Bitcoin. Now, remember, this is Pacific Northwest. This is Amazon and Microsoft, and we're rich because we're smart, and they want to have nothing to do with anything. But what I said is, they said, well, there's not a hedge against inflation because inflation was 9% and Bitcoin didn't go up. I'm like, oh, wait a second. In the last 2 years, the Fed, this big spike on the chart, the Fed printed 50% of all the dollars in the history of the Republic, 256 years. Oh, interestingly, if you print 50% of the dollars, that means you basically devalued by 100%-ish, right? Because you've doubled the money supply. Bitcoin's up precisely 100% in that 2-year period. It just happens faster because it's not a lagging indicator like inflation. Inflation is a lagging indicator. It's what happened a year ago or 6 months ago. It's not real time. It didn't happen immediately when they printed the money. The money printing is finally making its way through the economy as it cycles through. So now you're seeing this massive collapse in real wages. And this is the theft. This is the, again, sinister Saturday. This is the impoverishing of the masses.
Yeah.
This is intentional. This is absolutely intentional to make people poor. Then you give them UBI or soft UBI. We forgive your loans. We send you a gas card. We give you a little checky, for cost of living, and we make you dependent on us. And now freaking Gavin Newsom is going to run for president. Oh my God. Are you kidding? He thinks if he can hand people gas cards, he's going to get no, run away. Run away from these people.
I want to talk a little bit just about this inflation handle, because we got over 9%, right? Which is, again, this has been continuing to surprise to the upside, right? And you could see there's this chart going around on Twitter of everyone predict. Okay, there was actually something pretty funny. Like all the investment banks, right? Citi, Goldman, Barclays, whatever, they're all predicting. They've all got their prediction for inflation. I think Goldman, they were predicting slightly over the expectation of 8.8% headline CPI, right? So there is 8.8, and they predicted 8.88 or something like that. Came in over 9%. What was the lowest one was Visa. Visa was calling for 8.6% inflation. I thought that was a little funny. Maybe no one else does think it's as funny as I do. I wonder if that actually means that inflation is going to turn over, because I would guess that Visa has access to the most real-time data. You know what I mean? Way better data. I think it might be telling. I haven't seen anyone else talk about this, so I'm a little hesitant to voice it because I don't really know here what data they were using versus the investment banks. But I would guess that they have access to the most real-time data in terms of payments. Like, wouldn't they be kind of ahead of the trend in terms of predicting this stuff? But anyway, for listeners who are just listening and not following along visually, you can see, what is driving. We're looking at headline CPI, and it's broken out by categories. So we're looking at energy, food, goods, and services. Here, two interesting things here. So goods inflation is actually collapsing, right? That was what was making up the lion's share.
Used cars.
So that's starting to finally moderate, like folks were predicting. Energy is, I would say the the lion's share of the increase here. And services is steadily ticking up. Services is steadily ticking up as well. And food is still the smallest overall category, but the most worrisome in my opinion.
Well, services is that residual effect of my input costs go up. I'm a restaurant. My food prices go up. My machine prices go up. My commuting cost back and forth to work go up. And I'll give you the example. So my barber, you may like him or not like him, but I like him. And he says, how I decide when to raise my prices is when I don't have any money left in my checking account at the end of the month. It's like that's how I determine my price, and that's how you can judge inflation. And he tends to increase in bumps. Like he'll go, when I first moved here 24 years ago, it was $10, and then he raised it to 12, then it was 15, and then the last bump was from 15 to 20. That's a 33% increase. Now he should have done it over time, faster, but he he's just a good old guy, and he's happy to do it that way. But what this chart is telling me, look, the energy piece, it's already rolled over. We're down into sub $100 oil. Oil, mark my words, will be approaching $60 by the election. Gas prices will be collapsing by the election. It's the last chance the Dems have to get any positions, or else they're going to lose everything. I mean, they have messed up so badly, but they will cut a deal with Saudi. Saudi will pump. They won't pump 1.2 million barrels a day like someone reported the other day. That's just nonsense. But they will pump, and they'll announce it, and prices will head back down, and that will collapse the CPI. And then services might, you can see services on the left-hand side of this chart were really stable around that 2% level. And then when energy prices were negative, they went down. Well, why? We were locked in our house, right? We weren't using gasoline. We weren't going to restaurants. So yes, the services element went up. Well, now everybody is going out to eat, and everybody went to the UK with us, except London. London was not very busy. Edinburgh was busy. Dublin, super busy. And the airplanes were packed. And Heathrow is now having to limit the number of passengers in because the airport's just not big enough. But I do think oil prices are coming down. This is going to roll over. This will be yesterday's story. And the other part that's going to happen is the continued collapse of equities is going to weigh on people's wealth, their feeling of wealth. And home prices are going to collapse too because we raised mortgage rates. So all those things are going to lead to deflationary pressures. Demographically, we got bad deflationary pressures. Look, I'll say over the next 12 months, I'll bet you long bonds kick the crud out of stocks.
Really? Interesting. Oh, yeah. That's a pretty elaborate on that a little.
It's a bull call, Cotton. Then he says got to do it. I'm all over bull calls. I'm calling the bottom in Bitcoin. I'm calling bonds beating stocks. Maybe it's because I took a vacation and I got a little rest. Well, I didn't get a lot of rest because I was working on stuff. But I don't know. Maybe I just feel really energized. I do feel contagious.
I love it.
I like it.
I've got here's something that I can't really square, right? This is the thing that's tougher to predict, and I get that it's a little messier because it's a mid to longish term prediction, but those drivers of deflation, right, that we talk about, debt, demographics. What's the third one again? Debt.
Well, debt demographics lead to deflation. So excess debt, bad demographics lead to deflation. I
sort of for the first time see like just long-term inflationary pressures in the form of, I think another big thing that was driving deflation over the course of the last 30 years or whatever is we were able to borrow from low-cost labor pools indiscriminately. And I saw this when I was a consultant working in supply chain. And supply chain, you've got your trifecta of like quality, speed, cost. And it was just everything was so optimized for cost. And now you're facing political pressures, right? Where, especially if you have some sort of, if you're manufacturing some sort of good that's, could be argued has an element of national security to it. You're just not politically as free, right? It's a whole other risk factor, right, to manufacturing over in either Vietnam or China.
Nationalism is definitely inflationary. You're 100% right. And look, it's, I mean, I actually feel really bad for the guy. I mean, he's in a place that he can't succeed,
Who,
and he just
Biden?
looks like a buffoon half the time. Yeah, I mean, exactly. You know who I'm talking about, because the other day he says China's not the manufacturing powerhouse of the world, America is. Like,
that's what? Whoever's running his social media should be fired. Honestly, I mean, it's the amount of tweets I've seen and just been like, what are you talking about? It's just, I feel for the guy too. I do.
It's just wrong in that it's like we manufacture nothing. We manufacture oil, which is not really manufacturing. We pull it out of the ground and we send it off. And we manufacture cars. We do manufacture cars, but that's it. We don't manufacture tchotchkes. I mean, look at everything in your office. Turn it over. It says made in China. And that's not good or bad. But to your point on low-cost labor pools, it's 100% true. And if you look at the number of countries that are now transacting in rubles and renminbi and their local currencies moving away from the dollar, all of this is all toward the renminbi becoming the world reserve currency. Long before Bitcoin does, and I think it eventually will, it will be the renminbi. And everybody says, the dollar's so strong, the dollar's so strong. Like, no, it's not. It's strong against the other really bad ones, like the yen and the euro, but against the renminbi is still hanging in there strong. So I do think supply chain will mend. I do think that other low-cost labor pools like Indonesia and Vietnam, Burma, et cetera, will emerge. And some of that will get ameliorated. But I think you're right that this nationalism trend and this, make it in America and let's go to national security, all of that is inflationary. But I think it's trumped. You can't even use that word anymore. It just makes me mad, right? It's overruled. It's overruled by the fact that old people, okay, they don't consume as much, they don't spend as much, they save, and they buy bonds, right? And Rob Arnott writes very eloquently about this. The demand for bonds in savings over the next 15, 16 years, as my cohort of boomers, right? I'm the second to last year, my wife's the last year. But as the earlier boomers start to really retire, they will be selling equities, converting to bonds, and that is deflationary. They're downsizing their houses. We just did it with my parents. All of that is deflationary. And then the technology is accelerating. We're going to strip trillions of dollars out of the middle of financial services and all the things that blockchain technology does. That's deflationary. So I agree with you, while kind of on the other side making a case that maybe there'll be forces that overwhelm the very.
Here's a view that I'm starting to develop, and I'd love to get your opinion on it. I think at some point we need government to stop being dysfunctional if we want to solve the problems but let me qualify that just by saying, like, Amen. Okay, so if you want to go back and look at previous inflationary periods, the ones that people love to talk about in the US are the 1970s and the 1940s, right? In the 1970s, there was a very clear decision between price stability and recession, right? To the point where Volcker, depending on how you look at things, as a savior or like whatever, he caused two big recessions, but he eventually broke the back of inflation when he took Fed funds to 20%. Yep. There actually is, and that has, I think, correctly caused people to kind of repeat this mantra on this line of, when made to choose between price stability and inflation, the Fed will, and in my opinion, should pick price stability. That being said, there's another period, the 1940s, where there was a larger enemy than either the recession or inflation, and that was the war, right? And in that case, national security superseded everything, including price stability. They let inflation run hot, and they kept Fed funds rate down below zero. The other thing that happened, though, was actually productive investment on the government side of things. Admittedly, that was spurred by a war, but they put money into things like aluminum factories, right? Steel. They invested in technology, right? And all of those things actually helped pave the way for the next 60 or so years of growth. The thing that's going on right now that's concerning, right, is that none of that productive investment is going on. And I actually think one of the reasons, like, look, if you look at the chart of stocks, right, like when COVID happened, all this money just went into speculation of like the worst equities. It wasted everyone's time for 2 years, and then we're right back to where we were. But everyone's just more pissed off than they were eventually. And I think part of the reason is there's no funding source. There's no funding that's set up to invest in these like higher capex intensive industries, right? VC is largely suited to software, and that's great. We've produced a lot of great software companies. VC is, I think, the correct funding mechanism or funding source for crypto going forward. But like eventually we need to, a lot of these, really important industries that are higher capex, they should get invested in too. And eventually government needs to start being a part of the solution here, right? I just don't see a good path towards it.
Look, amen. Look, and look how close we are to a really critical point with chips, right? The entire fate of the known world, right? Not to be too dramatic, but to be that dramatic, relies on Taiwan Semiconductor, right? Taiwan Semiconductor is the most important company in the world. And should China, like I think I've told the story, we have a conference table in our China room, right? We have Brazil, Russia, India, China conference rooms, and we have maps. And in the China map, Taiwan is part of China. Now, the tables were made in China. So that's their view, right? And so if they were to just say, you know what, that's ours, that will cause, it might actually cause World War III, but it will cause a disruption of epic proportions that the world is not ready to deal with. And to your point, we could solve some of that by partnering with Intel and AMD, or maybe a new startup with gallium arsenide technology from down the road at NC State. Look, for years I've said, you want to solve most of our problems? Stop treating Social Security like a pay-as-you-go system and do it like the Singaporeans do. Set up a fund, a giant fund that only backs venture capital, growth equity in technology. And it will fund Social Security because it will generate huge returns and do the social good that you're talking about. And it's so easy, except it'll never get done because we got 538 people that all want it to benefit their district. And so you need to fund my project. No. You don't get to do any. You just put the money in a pot, you hire a team, and the team will manage the money. You don't get to tell where it goes. So we'll have no more Solyndra.
What was Solyndra?
No more stupid stuff.
Well, what was Solyndra?
Solyndra was a pork barrel solar project where you had these tubes that supposedly the light shone in, and it made like the super hot thing to power. And it was under the Obama administration, and it was total loss. Total wipeout because it wasn't good technology. But it was pork, and I don't remember the number. But
I was actually gonna. You know much more about this than me, but if I could push back a little there, because I was under the impression that was like part of a larger investment, that the whole Obama administration made. And if you looked at like the return on that government investment pool, it was actually pretty good. Solyndra was like a huge, big wipeout, right? But overall, it's like
I think it probably was really good, Michael. But my point was the decision to put Solyndra in there was not economic. The idea to make those investments is great. And to the point, even with a bad selection system, they got some good companies and a good return on investment. And it was exactly the right thing to do. What I'm saying is if you did it the way, the Singaporean government does it with Temasek and the government of Singapore, they have incredible teams, like teams of leagues of people who have a background in doing technology investing, and they invest, and they don't just invest in the greatest early stage technology. They invest in They made a great investment in a tea tree plantation in Australia. Right? Tea tree is this super hard wood. It's like harder than teak and has medicinal properties, and it's very highly prized all over Asia. And it grows really fast on this one side of Australia. And they made a huge investment in that and made a boatload of money again. And the government gets the money instead of, and the people, because their social security system is fully funded, overfunded.
Yeah, it's definitely an interesting system. I wonder. Well, you tell me again. I'm venturing into stuff I don't fully understand, but my understanding, right, of different, the reason why different countries have sovereign wealth funds, right, is that it's like a company, right? If they're almost like over earning and they have nowhere to productively reinvest the capital internally, they want to earn a return on that capital, so they bring it overseas, largely to the United States. Because when I first was learning about sovereign wealth funds, I was like, these actually seem like pretty good ideas. Like, why don't we have one of these in the United States? And I was like, the reason this whole system exists is because, like, especially like Saudi Arabia, right? Like, they're over earning on their oil, but they've got nowhere to domestically reinvest it. So they got to repatriate. They got to put that overseas, and that's why they buy U.S. Treasuries.
But here's the thing: we do have lots of assets, right? Everyone talks about, the U.S. is bankrupt and we have all this debt. Like, no. Remember, we have assets. Like, we have land, like lots and lots and lots of amazing land. And we have mineral rights and resources. And this whole thing about, we're not going to let any more drilling in Alaska. How about this? How about we sell off leases to drill to global companies and take that money and put it in a fund to then make them as? Or how about we sell pieces of land in the flyover states? And I don't mean that derogatorily. I mean, literally, when you fly over the United States, there's a lot of land. And there's just very few people living on it. And let's load up planes, literally, let's send planes to the best universities in China, in Singapore, in, wherever you want, and bring back PhDs. And let's say, here's some land, build something. Like, build cities and build communities and build businesses, and we'll own a piece of it. And people are like, no, we want to keep all the people out of the country. The country was built by people who didn't live here. We came here and we used this great resource, this land, this protection, and all these things. There was a great chart, and I can't remember where I saw it. It was on Twitter, but that showed children of immigrants are, I think it's 100%, which means twice as likely to be successful as children of non-immigrants. And that's a little skewed, and it probably has a lot of privilege bias, but not really, because it's the opposite. You're talking about people who came over and their parents, started a business, convenience store or a hotel chain. I mean, entire downtown Raleigh, right? 20 miles from where I live, all the hotels are owned by Indian families. And that is not a racist statement. It is a fact. And how did they do it? They came over, they bought a single hotel, they lived in the hotel. The guy that worked for us tells the story of he lived in the hotel and he had to do some stuff he didn't really like to do. And then they bought another hotel with the cash flow, and they bought another hotel, and they bought another hotel. And that's really cool. And now he goes off to college and he goes to do great things, and he's working for this big Hong Kong-based investment firm. And I mean, those are great stories.
That's the American dream. Mark, unfortunately, I know we've got to wrap a little bit early this week. I love ending on a nice story like that. As always, favorite, it's not quite an hour this week, but 30 minutes of this week.
All good.
And we will see you same time next week.
All right. Thanks, my friend.
Cheers.